Welcome back to another episode of Stock Talk. If you guys are new to my channel, welcome. My name is Julie. In today's video, I want to give you 11 dividend stocks that I think will do really well in the upcoming months and next couple of years. And the first stock on my list is Walmart. Walmart is one of the largest retail and wholesale businesses, and it's been around since 1945. Now, they're currently paying an annual dividend yield of 1.66%. And the payout ratio on Walmart is also very attractive, which is only 34%. And if you started investing in Walmart 10 years ago, you would have a return of 130% on your money. Additionally, the analysts are giving Walmart a moderate buy rating with an average price target of $163, and that leaves you with a 17% upside potential from here. I also like Walmart right now because it's sitting on the 100-day moving average, and that's always a great opportunity for you to start a position in any of the companies that you're looking at. Now, the next stock on my list is Smucker's, and Smucker's engages in the manufacture and marketing of food and beverage products. It actually operates through the following segments: retail coffee, retail consumer food, and retail pet foods, as well as international and away from home. The U.S. retail coffee segment includes domestic sales of Folgers, Dunkin' Donuts, and Café Bustelo. The U.S. retail consumer food segment includes Smucker's, Jif, and Crisco. And the U.S. pet foods are made of Rachel Ray Nutrish, Meow Mix, Milk-Bone, Natural Balance, and Kibbles and Bites. The company was founded in 1897 and has its headquarters in Ohio. Now, Smucker's is currently paying an annual dividend yield of 3%, and we take a look at the valuation and the profitability, we can see that it has a B rating. Additionally, Smucker's has not missed its earnings in the last 10 quarters, and if we take a look at the payout ratio, we can see that the dividend payout ratio is at 45%, which is also very attractive. Now, Smucker's just bounced off the 100-day moving average and currently sitting on the 50-day moving average. So you might or might not want to wait for it to come back down a little bit, but I think you could start a small position on the 50-day moving average if this is a company that you're interested in investing. The third stock on my list is Constellation Brands, which was founded in 1945, and it engages in the production, marketing, and distribution of beer, wine, and spirits in the United States, Mexico, New Zealand, and Italy. The company's iconic beer brand includes Corona, Modelo, and Pacifico. And its premium wine and spirit brands include Robert Mondavi, Kim Crawford, Miami, The Prisoner, Svedka Vodka, Casa Noble Tequila, and High West Whiskey. The analysts are currently giving Constellation Brands an average price target of $274, which leaves you with a 25% upside potential from here. And the annual dividend yield is 1.42%. Now, that's more on the conservative side. However, given that the payout ratio is also under 32%, and their profitability has an A rating, I think this is a great company where you could park your money. Additionally, if you had invested in this company 10 years ago, you would have a return of 870% of your money. So that would have been an incredible investment. And just like Walmart, the stock is currently sitting on the 100-day moving average, so a great opportunity to start a position if this is a company you want to invest in. The next stock on my list is Kellogg, which Kellogg engages in the manufacturing, marketing, and distribution of ready-to-eat cereal and convenience food. The company was founded by Will Keith Kellogg in 1906 and has its headquarters in Michigan. Now, the analysts are currently giving it a hold rating, and it has an average price target of 67%, so there's only little upside potential of about 4% here. However, the dividend yield is what makes this stock very attractive, which is 3.6%. Now, the payout ratio is a little bit on the higher side compared to the other stocks that we've seen so far of about 55%, but nevertheless, it's considerably low. Also, taking a look at the valuation and the profitability, we can see that the company has B ratings, and it has only missed their earnings report once since 2018. So overall, I think this makes a great candidate for a long-term investor. The next stock on my list today is Kimberly-Clark. Kimberly-Clark was founded in 1872 and is a Texas-based company. It manufactures and markets products made from natural and synthetic fibers. It operates through 3 segments: personal care, consumer tissue, and KC Professional. The company's iconic brands include Depend, Huggies, Kleenex, Kotex, and Scott. This stock currently has a hold rating and an average price target of $134, which also leaves you with little upside potential, but it also has a very nice dividend yield of 3.5%. Now the payout ratio is a little bit on the higher side of 92%. However, looking at the dividend history since 1985, we can see that this company has steadily increased their dividend payout. Additionally, it's currently sitting on the 300-day moving average. So that makes it a great opportunity to start a position if this is a company that you guys want to invest in. The sixth stock on my list is Colgate-Palmolive, and Colgate has a multinational consumer product name that engages in production and distribution of household, personal care, oral care, healthcare, and veterinary products. The company sells its products across more than 200 countries and territories, and is well known for its brands that include Colgate, Palmolive, Speed Stick, Lady Speed Stick, Ajax, and Soft Soap. Colgate is currently paying a dividend yield of 2.33%, and its payout ratio is only 56%. It also has a very long history of dividend payout and their dividend growth. Additionally, the profitability has an A rating, and it has not missed its earning reports in the last 10 quarters. And the stock currently has a hold rating, however, it has an outperform rating, and it has a price target of $86, which leaves you with an 11% upside potential. Moving on to my next stock is Campbell's Soup. And Campbell's Soup operates in two segments. Meals and beverages include the retail and food service businesses in the United States and Canada. And the segment includes the following products: Campbell's Soup, Swanson broth and stocks, Pacific food broth, soups and non-dairy beverages, as well as Prego pasta sauces and Pace Mexican sauces. They also have Plum baby food and snacks, V8 juices and beverages, and Campbell's tomato juice. Snacks include Pepperidge Farm cookies, crackers, fresh bakery, and frozen products in U.S. retail, including Milano cookies and Goldfish crackers, as well as Snyder's and Hanover pretzels, Lance sandwich crackers, Cape Cod, and Kettle brand potato chips. And the company was founded in 1922 and has its headquarters in New Jersey. Now, this stock currently has an outperform rating and an average price target of $46, which currently leaves you with a low upside potential, but I do like their dividend payout. The annual dividend yield is 3.29%, and they do have a payout ratio of under 52%. So that is very favorable. Additionally, if we take a look at their evaluation and their profitability, we can see that they have big ratings there, and they have only missed their earnings report once since 2018. Moving on to my next stock is Altria Group. Now, Altria Group is a tobacco company. I'm not endorsing them, and as always, you guys have to do your research on all of these companies anyways, but I do want to point this company out because it has a very nice dividend yield of 6.9%, and their payout ratio is at 76%. They also have a really good valuation and profitability, and the analysts are giving it an A rating. Also, we have a smart score of outperform, and the analysts are currently giving it a $50 price target, so there is some downside potential. But moving on to my next stock is Unilever, and Unilever is a London-based company that sells fast-moving consumer goods worldwide. The company operates through three segments, which includes beauty and personal care, food and refreshments, and home care. Its popular brands include Axe, Dove, Glow and Lovely, Heartburn ice creams, Hellmann's, Lipton, Sunsilk, and many others. And the company was founded in 1930. Now, we currently have a moderate buy rating and an average price target of $65, so that leaves you with an upside potential of 36%, and the dividend yield is a nice 4%. Now, the payout ratio is also a bit on the higher side of 65%, but again, remember, we're looking at payout ratios under 100%, so any of these stocks qualify so far under the payout ratio. Additionally, taking a look at their profitability, we can see that they have an A rating. All right, moving on to my second last stock is Pepsi. Now, Pepsi has not missed a single earnings report since 2018. It currently has a moderate buy rating and an average price target of $180, which leaves you with a 10% upside potential. Pepsi does have one of the lower annual dividend yield, which is 2.6%, and their payout ratio is at 85%. However, if we take a look at the profitability, we can see it has an A rating. Additionally, if you invested in Pepsi 10 years ago, you would have 163% return on your money. And looking at the chart, Pepsi is currently hovering on the 50-day moving average, so that could offer you a great opportunity to start your position in Pepsi if this is a company that you want to invest in. And my last stock for today is General Mills, which General Mills is a multinational food company. It has a headquarters in Minneapolis, and the company manufactures and markets branded consumer food, which it sells through retail stores. Its products category include convenient meals, ready-to-eat cereal, snacks, super premium ice cream, yogurt, baking mixes, and ingredients, in refrigerated as well as frozen dough. The analysts are currently giving it a neutral rating and a price target of $66, so you may want to wait for the stock to come down to one of the moving averages. But I do want to point this stock out because it also has a nice dividend yield of 3%, and the payout ratio is just under 55%. Additionally, taking a look at the profitability, we can see it has an A/C rating. As always, be sure to do your own research on any of these companies. If you guys got anything out of this video, please be sure to hit that like button and consider subscribing to my channel. And I'd be interested to find out if you guys own any of these companies or are considering investing in any of these companies. If you are, please be sure to leave me a comment below, and I'll see you guys in my next video. Until then, bye-bye.